Futures taking a leg lower this morning, and joining us right now is JoAnne Feeney, partner and portfolio manager at Advisors Capital Management. Of course, the question, JoAnne, is when we're talking about a bubble, every time people talk about a bubble, including myself talking about a bubble these days, whether that means we're really not in one yet, or at least that it's not ready to pop. What do you think?
Well, Andrew, I don't think we're in a bubble. We look at history of bubbles. This doesn't look like any of those because the companies that are involved in some of the strongest appreciation have the sales, have the profits, have the balance sheets to support the very large spending that they're doing. I would note that OpenAI is a bit of an exception. Clearly, they're getting their funding through their suppliers, and that's a little bit of an unusual situation, but one I think we can explain. So overall, no, I don't see a bubble, although I do worry about those low quality stocks that have been bid up. I think there might be a bubble over there.
So when you hear a David Solomon or a Ted Pick say that he thinks that a 15 to 20% correction could be in the offing, you think what?
Well, I think it's very common, first of all, to see drawdowns of 10% or more. In fact, 10% is something we see in about half the years in the history of the stock market. So we should expect that. I don't think that suggests that we're in a bubble. In fact, when you look at the companies most folks are concerned about, they're the ones that are leading growth in earnings. They have the free cash flow. In fact, if there's a risk out there, it's not so much to valuations of those companies, it's potentially to the earnings growth outlooks. Right now, there's an awful lot built in. We think a lot of it is justified, but that's where I would look for the risks.
In terms of stuff you love right now, what would you be doing?
Yeah, well, it depends obviously on the investor, but for the growth investor, you want to definitely be exposed not just to the leaders in AI, but also to where the applications are now starting to roll out. And those are appearing in industrial companies, in financials and elsewhere. So, Broadcom has long been a holding for our clients since, I think, 10 years ago when I first joined the firm. That's a favorite. AMD is certainly more of a risky play because it's smaller and more concentrated, but they're clearly, I think, in a position to gain share. And then beyond that, folks often overlook the importance of cybersecurity and its growing role as AI rolls out. So we like Palo Alto in that case.
One of the questions I get asked a lot these days is whether, if you do think that this 10% correction is coming, should you be sitting on some part of your portfolio should be cash because there'll be some kind of great opportunity? Do you see that, or are you fully invested?
That's always a challenge. The difficulty with sitting on cash is that there's an opportunity cost. Now, you can earn some yield on that cash, and that's some compensation. But, you could be sitting on that cash for a long time before there's a meaningful enough pullback that you put it to work. And in the meantime, you've missed some appreciation. So what we prefer to do for our clients, say in a balanced strategy, is to look for more resilient, perhaps more boring names, one that have yield. Things like a KMI or an AbbVie, some of the bank names. Consumer like a TJ Maxx has been one of our favorites for a long time. These are names that provide some resilience, particularly to a balanced, sort of more conservative strategy that enable, clients to be positioned if there are drawdowns. Those kinds of stocks are likely to go down far less.
How correlated do you think crypto is to the stock market at this point? We were looking at Bitcoin this morning down to about $103,000.
Yeah, I think it's pretty clear that crypto has become, a speculative asset. And so you see it climb when the market's doing well, particularly when those low quality stocks are driven up. So it's really more of a signal about whether the market is sort of risk on or playing to more conservative, more value oriented names. So I don't think it does much good as a diversification tool. I think you're better off with some, boring, higher yielding stocks that are going to do well, even if, some of these risks that we haven't talked about, you and I, but everyone else is, whether it's political risk, labor market risk. I mean, if these tariffs remain in place, we could see a lot of small businesses struggle and go bankrupt. We're not picking up that data in the labor market. It's not picking up much data in the labor market right now. But that's, I think, where there's more significant risk. And so there's better ways to diversify than going over to crypto.